Money FM 89.3, best of breakfast. The US Market Update with Money FM 89.3.
Good morning, folks. Welcome to the US Markets Wrap with me, Ryan Huang. And taking a look at Wall Street, red on the screen. So the S&P 500 retreating overnight, extending last month's sell-off and turning red for the year after President Donald Trump's confirmation of forthcoming tariffs. So the broad index dropped 1.8% to 5,850, marking its worst day since December. And we've got a Dow Jones Industrial Average dropping 1.5% to finish at 43,191. And the biggest loser was the Nasdaq Composite, sliding 2.6%, weighed down by Nvidia's drop of more than 8%. For more insights, we are joined by Dave Sekera. He is the Chief US Market Strategist at Morningstar Research Services. Dave, thanks for joining us on the show. How are you doing today?
Oh, I'm doing well. How are you?
Always great to have you on, Dave. I'm doing well as well. And to kick things off, I suppose we've got to zoom in on those tariffs. So President Donald Trump has reiterated that 25% levies on imports from Mexico and Canada will go into effect. So it looks like we are not going to get a last-minute deal.
Well, we shall see. I think one of the hardest things to do in investing is learning how to separate signal from noise. And in today's environment, in the U.S., I think you also need to try and learn how to separate, what President Trump says versus what he actually does. So we've really remained focused on, individual fundamentals, evaluations. And once we have, any sort of specificity on the tariffs or changes in regulatory policies, that will actually be implemented, we will then go ahead and adjust accordingly. But for now, I think the situation remains, very fluid. We're still talking to a number of our contacts in Washington, D.C., trying to discern whether or not there's still any possible extensions, here at the last minute. In my own mind, I think as long as trade negotiations with Canada and Mexico are making progress, I do think there's still a good chance that tariffs, could get extended, once again. If they're not, if they are put into place, then of course the questions become, how long will the tariffs be in place? Whether or not there's any products that will be excluded from the tariffs, and of course what type of retaliatory tariffs will be put in place by Canada and Mexico on U.S. products.
Yeah, and we also are looking out for what's happening with China because of the potential 10% levies, additional levies levied to potentially to be levied on China. So they are also having these two sessions this week, which could see an announcement of sorts when it comes to responses. What are you looking out for on that front? Could we see them responding in a way that could make Donald Trump think twice?
Well, there's certainly a lot of levers that they have that could make Donald Trump, think twice. In my own view, I still think we're probably in relatively early rounds with negotiations with China at this point. I kind of liken it to, two, heavyweight boxers in the ring. They're each, making a couple of jabs at one another, looking for an opening. But I don't think we've really got into, the fight just yet. So, for example, I know, China had made, some commentary about maybe starting an antitrust probe, looking at Alphabet. We don't see much substance in that antitrust probe at this point. We think that's really just a negotiation tactic for tariff discussions. So I think there's still a lot more left, yet to come with, both sides really shoring up, what their responses to one another are going to be before we get into, the real fight between U.S. and China as far as trade goes.
Yeah, talking about trade, the trade outlook as well as the economic outlook seems a bit worrying on a few fronts. If you look at consumer sentiment, it does look like we've got the lowest levels in some 8 months going by some metrics. What are you taking away from some of these latest indicators?
Well, the consumer sentiment metrics, I always take them with a grain of salt. In the U.S., one thing I've learned over the years, especially being a consumer analyst in early part of my career, there's always a difference between what consumers in the United States say versus what consumers in the United States end up actually doing. And consumers in the U.S. always seem to have a propensity, to be able to spend more than you think that they should. And I think that's partly in case, what we've seen, over the past year and a half. Now, of course, inflation in the U.S. for the past 2 years has been much higher than it's been historically. I think low-income households and to some degree middle-income households are still feeling the pressure of that 2 years worth of inflation on their pocketbooks. We have seen some changes in consumer spending over the past year. A lot more consumer spending, especially in like low-income households and even some of those middle-income households, is really going more into consumables and food than what we've seen in discretionary products. So that is a trend that we expect to continue to see, although I am watching wage inflation. So I'm hoping that over the next couple of quarters, wages will outpace inflation, and that will help purchasing power in the lower income households going forward.
Yeah, some pressure on sentiment for now. And talking about pressure, we are seeing some pressure on Nvidia. And I'm trying to wrap my head around what's happening here because we saw a beat on both the top and bottom lines, but investors are not sticking around. What's happening here?
Well, I think the decline in the stock price really has to do much more with the change in sentiment than the actual results, that came out. As you mentioned, they did beat on both the top and the bottom line. The guidance that they provided was higher than what the consensus was expecting. But overall, we did maintain our $130 per share, fair value estimate. And that's actually much lower when you look at the average price target on Wall Street. That was still $175 a share. So I think, what's going on is that the market is still pricing in a lot of growth, but I think they're becoming disappointed that growth is growing at a decelerating rate, whereas for much of 2023 and 2024, growth had been accelerating, at an accelerating rate. So I think it's just much more with what we've seen in AI in general, that a lot of the intelligent AI stocks have been losing their luster. Really, we saw that, about a month ago when the DeepSeek scare, really ended up pushing a lot of those AI stocks down. In fact, many of them are down, 15, 20%. So getting actually pretty close to a correction territory. Yet I still think a lot of them that we follow still may have further to fall here in the short term.
Yeah, so Nvidia trading at 114 after a drop of more than 8% overnight. So talking about that correction, is this time to go bargain hunting then?
Not probably just yet. I think at this point, I'd still like to see a good 5% correction across the board in the U.S. market before I'd start putting new money to work. When I think about the valuation of the market, coming into the year, we noted that U.S. stocks were trading about a 4 to 5% composite above our fair values. So following today's sell-off, the market overall is probably down about 2%. So I think stocks still trading right around or a slight premium overall to our fair values. But there are some areas in the market we like. We still think that investors should be overweight value stocks today. And in order to pay for that overweight and value, I would underweight growth. In fact, growth stocks coming into the year with some of the highest levels above our fair values that I've seen really since the disruptive technology bubble in 2021. So I think value has actually done pretty well thus far this year. Last I checked, it was up 4 or 5%, whereas growth stocks are down 2 or 3% after today's sell-off.
Yeah, let's talk about some of those value stocks. What are some of the names that come to mind right now?
Yeah, one of the ones I've really been following very closely lately is Hershey. And part of the reason I like is Hershey, when I look at the price chart and our valuations, hardly ever has that much of a discount to our fair value. Last I checked, it's a 4-star rated stock. We use a star rating scale where 5 is where we think the stocks are most undervalued. So definitely getting into an attractive territory. Trades at an 18% discount to our fair value, provides a 3.2% dividend yield. And this to me is just really a traditional value stock right now. The stock price is low because global cocoa production declined 14% in the 2023 and 2024 growing seasons. But we expect that conditions will normalize. New supply will come online, and that will help bring earnings up over the next couple of years as the costs start to normalize.
All right, that is one to watch out for, Hershey's. And I suppose on the other end of the spectrum, there are going to be a couple of stocks you might want to avoid. Walk us through what we should be keeping an eye out for.
Now, first of all, I have to highlight Tesla. Tesla is still trading at a pretty large premium, to our fair value. This is a stock that, during the campaign season and after President Trump was elected, based on Elon Musk's, support for Trump and their friendship, the market really rallied, just expecting that there would be changes, in the regulatory environment that could end up benefiting Tesla. I think that stock has risen as much as it's probably going to rise, in the short term. Looking at the charts, it has rolled over. So I think there's, there's further downside left to go there. And then another one that I think will surprise people that we think is significantly overvalued is going to be Walmart. It's a 1-star rated stock. That's actually our lowest rating. Trades at over a 60% premium to fair value. I don't think people realize just how much the stock has gone up over the past year. It's now trading at a 39 times PE ratio. I mean, that's much higher than most of those artificial intelligence stocks that we've seen already starting to come down.
Yeah, looking at Walmart's stock price up some 64% in the past year. And I suppose to some degree there is also this overhang of what's happening with the consumer.
Well, actually, Walmart has been a big beneficiary of that, over the past year and a half to 2 years. So a lot of people, have been actually trading down to Walmart, which is an everyday low price retailer. So they've stopped going to the more traditional supermarkets and grocery stores. So Walmart has seen a good pickup in foot traffic, a very good pickup in short-term earnings. It's just that we think people right now are just over extrapolating that short-term growth, too far into the future. And that as wages come up and, people's purchasing power normalizes, we get back to more normalized purchasing patterns and people going back to traditional grocery stores.
All right, Walmart warning of a slower 2025. And we've been in conversation with Dave Sekera. He is the Chief US Market Strategist for Morningstar Research Services. Dave, thanks so much for your time and insights. Always great chatting with you.
Oh, of course. Well, thank you very much.
All right, hope to have you back on again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.